I'm literally holding in my hand what looks like just a standard, boring stack of bureaucratic paperwork.
Oh, yeah, the best kind of paperwork.
Right. It's the actual Q2 2026 SEC 13F filings for Pershing Square,
Hmm.
filed on August 14th, 2026. And, you know, for anyone who doesn't spend their weekends reading financial regulations, a 13F is basically the quarterly scorecard.
Yeah.
The government makes billionaires fill it out so the public can see exactly what stocks they're buying and selling.
Right. It's their required homework.
Exactly. And we are looking at a portfolio representing $19.466 billion
Yeah.
spread across, I think it's 14 distinct securities.
14, yeah.
But the thing is, this isn't just a dry list of trades. I mean, when you read between the lines, this document is a treasure map. It reveals a massive fundamental philosophical shift from, well, one of Wall Street's most famous and traditionally aggressive investors, Bill Ackman.
It is a profound pivot. I mean, maybe one of the most significant we have seen in modern value investing. Because our mission for this deep dive today is to decode why Ackman is radically changing his playbook.
Right.
We want to extract this specific owner earnings framework he's currently using and figure out how we can apply this mental model to our own financial knowledge base.
Which is huge.
It is. But before we pull apart a $19 billion portfolio, there is a vital piece of housekeeping we have to get out of the way.
Oh, right, the legal stuff. Go for it.
Yeah. Disclaimer, all analysis is based on publicly available sources and may be subject to revisions or differing interpretations. All contents from this channel is for research and entertainment purposes only and does not constitute any investment or financial advice or service. Conduct your own due diligence before making investment financial decisions.
Housekeeping checked. Let's get into it. Okay, let's unpack this. I mean, where do we even begin with a portfolio of this size?
Well, we begin by correcting a massive data illusion that is currently fooling a lot of amateur investors tracking these very filings.
Oh, really?
Yeah, if you go on standard 13F tracking websites right now, you're going to see a flashing alert that Pershing Square increased its position in Howard Hughes Holdings ticker HHH by a staggering 48%.
Wow. Which, I mean, that sounds like a massive vote of confidence. Like,
Yeah.
a 48% bump makes it seem like he's aggressively backing up the truck for real estate.
Right, the headline certainly makes it seem that way. But the economic change in his portfolio is actually 0%.
Wait. How does a 48% increase equal zero?
Yeah.
Did the stock price just collapse and offset the buy or something?
No,
Yeah.
not at all. It comes down to a purely structural change in how Pershing files their paperwork.
Oh, okay.
So in the first quarter, the traditional Pershing Square Capital Management 13F reported 18.852 million Howard Hughes shares, but they had a separate affiliated manager filing that held another 9 million shares. So the new Q2 consolidated filing, it simply puts both of those entities under one roof.
Ah, I see.
Yeah, so 18.85 million plus 9 million equals roughly 27.85 million shares.
So he didn't buy a single new share. He just, like, put all the existing paperwork into the same filing cabinet.
That is the reality. And it highlights why you have to read the actual filings, and understand the mechanisms behind them.
Yeah, rather than just relying on those algorithmic data aggregators that blast out alerts.
Exactly. But clearing up the Howard Hughes trap is just the appetizer for this quarter.
Okay.
The main course of this 13F is a radical evolution in Ackman's entire identity. I mean, for years, the public stereotype of Bill Ackman has been the relentless activist investor.
Oh, yeah. The boardroom brawler.
Right. He was the guy who would buy into struggling, mismanaged, or broken companies, write a 100-page angry letter to the board of directors, launch proxy fights to replace the CEO, and try to force a massive corporate transformation.
He was basically the Wall Street equivalent of a hostile takeover in a boardroom drama. Just comes in with a sledgehammer.
That was the old playbook for sure. But looking at these new numbers, he's leaving that boardroom brawling behind. And he's morphing into a classic Warren Buffett-style investor.
Interesting.
Yeah, he is aggressively hunting for what we call toll road businesses.
Whole roads, right.
These are capital-light, high-return-on invested capital machines, businesses that can just sit there and quietly compound their earnings per share at 15 to 20% or more for years.
Without all the fighting.
Without needing constant babysitting, turnarounds, or proxy battles.
Man, I love that concept. It's like he stopped trying to buy fixer-upper houses to flip. Because anyone who has done real estate knows the fixer-upper means you're always dealing with, like, leaky roofs, bad contractors, unexpected mold.
Oh, yeah, it's a nightmare.
Right. So instead, he's just buying the only bridge into town.
Right.
And collecting a toll from everyone who crosses it. You just sit back and let the traffic flow.
That is the perfect analogy, and it explains the mechanics of his strategy perfectly. And we see this toll road philosophy crystal clear in his massive new core investments for Q2.
Yeah, because the new additions are absolute heavy hitters. He initiated brand new massive positions in Visa, MasterCard, and S&P Global.
Yep.
I mean, we are talking over $1 billion deployed into each of these names.
What's fascinating here is the sheer elegance of how their underlying business models actually work. So let's look at Visa and MasterCard.
Yep.
Visa takes only about 20 basis points of a transaction's value.
Okay, so a tiny amount.
Right. For context, a basis point is 1/100th of 1%. So they are taking a tiny fraction of a penny on the dollar. But think about what they don't have to do to earn that fraction.
Right.
Visa doesn't lend you the money. The issuing bank takes all the credit risk. If you default on your credit card, Visa doesn't lose a dime.
Oh, right, because it's the bank's problem.
Exactly. Visa also doesn't sell the goods or manage inventory. The merchant handles all of that.
So they literally just provide the road. They are the digital asphalt connecting the buyer and the seller.
That's it. And processing one additional transaction on that digital asphalt costs them virtually nothing. The incremental margins are just extraordinary. It's a classic two-sided network effect in action.
How so?
Well, more cardholders attract more merchants, which then attracts more banks wanting to issue cards, which attracts more consumers looking for convenience and rewards.
Okay, I hear toll road, but my mind immediately goes to the threats on the horizon.
Sure.
Things like crypto, stablecoins, Apple Pay, or even just like direct bank-to-bank transfer tech like FedNow. If I'm paying 23 times earnings for Visa, aren't I worried that new payment technology is just going to build a frictionless bypass around my toll road and just bleed their pricing power dry?
It's a highly valid concern, and it's the exact risk that causes some technology-focused investors to hesitate. But this is where we have to unpack the Buffett playbook. You are buying an almost impossible-to-replicate global human and technological network. The sheer friction required to get thousands of fragmented global banks, tens of millions of independent merchants, and billions of habit-driven consumers to simultaneously switch to a brand new rail, it's astronomical.
So it's just too much inertia.
Exactly. Apple Pay, for instance, didn't replace Visa. It just built a beautiful user interface on top of Visa's rail.
Oh, that's true.
So Pershing is paying roughly 23 times forward earnings for Visa, with an expectation of 15 to 16% underlying earnings growth. Paying that multiple for a business with virtually infinite scalability and a near monopoly moat is textbook value investing.
Yeah, what about S&P Global? I mean, financial indexes and corporate credit ratings don't sound nearly as globally ubiquitous or, like, flashy as consumer payments.
They aren't flashy, no, but mechanically, S&P Global might be the best valuation-adjusted buy in the whole portfolio. Yeah, they owned absolute quasi-monopolies. Think about how the corporate bond market works. If a massive corporation wants to issue debt to raise money, they need an S&P rating.
Right.
The global regulatory infrastructure and institutional mandates literally demand it. Pension funds aren't allowed to buy unrated debt.
Wow, so they have to pay the toll.
They have to. Furthermore, if trillions of dollars passively move into S&P 500 index ETFs, S&P Global collects licensing fees on that massive pile of money.
Okay, that makes sense.
And here is the kicker. As those assets under management grow by billions of dollars, S&P Global doesn't need to build a new factory. They don't need to buy more steel or hire 1,000 new employees.
So it's the ultimate capital light model. The revenue scales infinitely, but the costs stay relatively flat.
Exactly.
But so if it's such a perfect business, why was it cheap enough for Ackman to swoop in and buy $1 billion worth?
Well, the broader market panicked over artificial intelligence.
Of course.
Yeah. There is this pervasive feel that generative AI could disrupt parts of S&P's market intelligence and data business, essentially commoditizing financial data. So the market multiple dropped from about 25 times earnings down to 19 times.
Okay, so Ackman saw a discount.
Right. He essentially stepped in and recognized the flaw in that panic. AI might be able to write a really good summary of a financial report, but an AI cannot replace legally embedded regulatory required credit ratings, nor can it replace the proprietary trademark of the S&P 500 index.
Which is such a brilliant transition, actually, because while S&P Global got cheaper because of AI fears, when we look at Ackman's big tech holdings, artificial intelligence is causing a very different and much more expensive problem.
Oh, the massive AI capex dilemma. Yes.
Let's look at the wild movements in his tech portfolio, because Ackman massively added to Meta, up 20.1%, Microsoft up 9.8%.
Right.
But at the same time, he dramatically slashed his Amazon position by 25.2% and completely exited Alphabet. Like, he sold out of Google entirely.
If we connect this to the bigger picture, this divergence between the tech giants is the most crucial valuation lesson of our entire deep dive today.
Okay, break that down for us.
It all comes down to the fundamental difference between accounting earnings and owner earnings. Let's look at Meta. Meta has an absolutely immense moat with Facebook, Instagram, and WhatsApp.
Sure.
But their 2026 capital expenditure guidance, what we call CapEx, is approximately $130 to $145 billion, driven almost entirely by the need to build out AI infrastructure.
$130 billion. That is, I mean, that's an unimaginable amount of cash just going out the door for servers, NVIDIA GPUs, cooling systems, power grid.
It is staggering. And if we look at Amazon, their trailing free cash flow, the actual cash left over after paying for operating expenses and capital expenditures actually went negative.
Wait, negative?
Yeah, because their CapEx exploded as AWS furiously builds out its AI data centers. So the defining question for a value investor analyzing these companies right now is this. Are these billions of dollars in AI spend growth investments that are going to yield massive future returns?
Yeah.
Or are they merely maintenance CapEx? Meaning, is this just the table stakes required to survive and not lose your market share to competitors?
Wow, okay. It's like buying a golden goose because it lays solid gold eggs. But suddenly the goose demands $100 billion in gourmet feed just to stay alive.
Exactly.
If you don't feed it, it dies and you lose your investment. But if you do feed it that much, you have to ask yourself, am I ever going to get enough extra gold eggs to actually cover the cost of all that gourmet feed?
That analogy captures the dilemma perfectly. If Amazon's AWS is spending $1 on AI infrastructure today to generate $3 of future value, then their current negative free cash flow is an illusion.
Right, they're just deferring the profit.
Exactly. They are wildly profitable long term. But if that AI spend becomes a permanent recurring cost just to remain competitive with mediocre returns, then their true economic earning power, the actual cash an owner could take out of the business, is much lower than their accounting profits suggest.
And looking at his trades, Ackman clearly feels much safer with Meta and Microsoft's ability to monetize that AI spend than he does with Amazon or Google. Hence, the 25% trim on Amazon and the complete exit from Alphabet.
Yeah, Microsoft has unparalleled enterprise distribution. They can plug their AI copilot into Word, Excel, and Teams and put it in front of hundreds of millions of existing corporate users immediately.
He's charging them, what, $30 a month?
Exactly, charging them $30 a month without having to acquire those customers one by one. Meta can use AI to instantly improve advertising conversion rates and content recommendation algorithms across their 3.6 billion daily active users.
Which is huge for their ad business.
Right, so the margin of safety, the confidence that this massive spending will result in actual revenue, just looks much stronger there than it did for Amazon or Google at their current valuations.
Okay, so if big tech is currently wrestling with this massive physical capital intensity problem, let's look at Ackman's single largest position. Because it relies on a totally different kind of moat. It doesn't own data centers or physical goods. I'm talking about Uber.
Uber, yes.
It makes up almost 13% of his entire 13F portfolio, and he just added another 14.6% to his holdings.
Yeah, Uber has completely evolved as a business model. You know, a few years ago, it was notoriously viewed as an unprofitable growth stock that just burned venture capital cash to subsidize rides.
Right.
Now the mechanics have flipped. It's generating over $10 billion in trailing 12-month free cash flow.
I hear that number, but I look at Uber and I still just see a taxi app on my phone.
A lot of people do.
Yeah. And with all the headlines about autonomous vehicles, Waymo expanding, Tesla promising robotaxis if fleets of self-driving cars eventually take over our cities, doesn't Uber just get deleted from our phones? Don't they just get completely disintermediated by whoever manufactures the best robotaxi?
That is the standard surface-level bear argument, but it profoundly misunderstands what Uber's actual structural advantage is.
Okay, correct me.
If you dig into Ackman's underlying thesis here, he doesn't view Uber as a taxi company at all. It is a global demand aggregation network.
A demand aggregation network. So it's about owning the intent of the customer, not the physical vehicle.
Exactly that. Let's say a company creates a perfect, fully autonomous vehicle fleet tomorrow. They still have a massive, mathematically complex problem to solve.
Finding riders.
Right. They need a constant stream of customers to keep utilization rates high. They need dynamic global routing algorithms. They need surge pricing mechanics. And they need a seamless payment infrastructure.
Which Uber already built.
Uber already has all of that operating flawlessly at a global scale. So Ackman's thesis suggests that Uber could simply become the ultimate marketplace, connecting third-party autonomous fleets with riders.
Oh, wow.
In that scenario, Autonomous vehicles don't destroy Uber. They expand its total addressable market while radically improving its unit economics, because Uber no longer has to share a massive cut of the fare with human drivers.
Okay, that completely flips the script on the risk profile.
Yeah.
It's not Uber versus robotaxis. It's Uber positioning itself to become the dominant operating system for robotaxis.
Exactly.
That underlying mechanism explains why he's willing to make it his largest position.
Yeah.
And speaking of flipping the script, we have to talk about the Netflix boomerang.
Oh, the boomerang.
Yeah, Ackman famously bought a huge stake in Netflix, lost confidence, took a massive loss, and exited completely in 2022. But now, he's back in. It represents almost 5% of the portfolio.
It's a fascinating return to the scene of the crime, so to speak. But the rationale makes complete sense if you analyze the mechanics of the streaming industry today versus, the panic of 2022.
Right.
The core argument now is that Netflix has essentially won the global streaming war.
They survived the bloodbath while the legacy media companies bled cash trying to catch up.
And because they survived and built such an insurmountable global subscriber base, we are talking over 260 million paid memberships. They can amortize their content spending better than anyone else on Earth.
How does that math work?
Think about it. If Netflix spends $100 million producing a blockbuster movie, they spread that cost over hundreds of millions of paying subscribers globally. The cost per user is tiny.
Oh, right.
A smaller streaming competitor spending that exact same $100 million is taking a massive existential financial risk because they only have 30 million subscribers to spread it across.
That's a huge advantage.
Plus, Netflix's valuation dropped from a peak of over 40 times earnings down to around 21 times, making the math much more digestible for a value framework.
The recurring theme across all of these moves is moats, scale, and capital efficiency. But there's another fascinating layer to this 13F. Ackman is heavily employing Warren Buffett's philosophies, sure, but in some cases, he's literally buying companies that are structurally cloned from Buffett's own company, Berkshire Hathaway.
Yeah. The Berkshire clones are a brilliant strategic move. Brookfield is the prime example.
Okay.
Structurally, the way Brookfield operates is incredibly similar to Berkshire. It sits at the center of this massive financial ecosystem combining insurance operations, infrastructure development, commercial real estate, renewable power grids, and private equity.
That's a lot of moving parts.
It is. But crucially, they have access to permanent capital through their insurance float. So when markets seize up and the economy crashes, Brookfield has the locked-in cash to go out and buy distressed assets at rock-bottom prices, just like Buffett has done for decades.
And it looks incredibly cheap on paper. I mean, looking at the data, it's trading at around 14 times forward earnings for roughly 20% EPS growth.
Wow.
Why is it so cheap if it's such a powerful model?
Well, it comes down to accounting complexity. It's not a simple, clean business like Microsoft selling a software license.
Right.
Brookfield is more like a matryoshka doll of accounting. You have to open the renewable power doll only to find the commercial real estate doll inside, which holds the private equity doll inside of that.
That sounds like a headache for analysts.
It is. And every single one of those dolls uses different math. They use complex terms like distributable earnings, fee-related earnings, and carried interest.
Oh, wow.
Whenever a company requires an analyst to make dozens of subjective adjustments just to figure out its normalized cash flow, the broader market typically applies a complexity discount.
Because investors hate what they can't easily model in a spreadsheet.
Right. A very profitable matryoshka doll, but confusing enough to keep the valuation low. We also see this Berkshire-like approach in Restaurant Brands International, ticker QSR.
Well, they own Burger King, right?
Yep, they own massive global brands like Burger King, Tim Hortons, and Popeyes, but they don't actually own or operate the vast majority of the physical restaurants.
Oh, they just franchise them.
Exactly. The independent franchisees put up the hard capital to build the stores, hire the staff, and maintain the fryers. QSR simply licenses the brand and collects a percentage of top-line sales as royalties.
So it's a beautiful way to generate incredibly high returns on your own invested capital while someone else takes on the messy physical real estate and operational risk.
Precisely.
Okay, this framework is brilliant. But as much as we are treating this 13F filing like a crystal ball into a billionaire's brain, there's a massive structural warning label we have to slap on this whole conversation for anyone listening.
Yes. The snapshot delay. This is a critical mechanism to understand about SEC filings.
Right, because the 13F we are looking at is a delayed snapshot of what the portfolio looked like on June 30th. It is absolutely not real time.
Not at all.
For instance, the filing shows Ackman held a small position in Hertz on June 30th. But we know from other public disclosures that he completely exited Hertz in July. On the flip side, He initiated new positions in Intercontinental Exchange, ICE, and Alcon after June 30th. So those billion-dollar moves aren't even visible on this document.
Which is exactly why you can never just blindly copy trade a 13F. I mean, by the time the public sees the paperwork 45 days after the quarter ends, the billionaire might have already changed their thesis and sold the position.
Exactly. Because of the limitations and delays of these filings, you can't just rely on outdated paperwork if you want to be a serious, informed investor. To access more advanced researches, follow Guru's latest movement, and leverage our latest Deep Values agents, welcome to download Deep Values app from App Store.
It really is all about having the right analytical data at the exact right time rather than just, looking in the rearview mirror.
And to track stock market temperature and broader macroeconomic trends, welcome to download iOS app Buffett Indicator from Apple App Store or Bubble Watch from Google Play. Links in the description. Because frankly, if you were trying to figure out if we are in an AI CapEx bubble or a true paradigm shift, you need tools that tell you the temperature of the water before you jump in.
That context is vital, and it brings us back to the core synthesis of what Ackman is actually executing here in 2026.
Right.
He is putting on a masterclass in a very specific mathematical equation regarding owner earnings. He has realized that a phenomenal company, organically growing its true cash flow at 15 to 20% for a decade, is actually far, far cheaper at a 20 or 25 times valuation multiple than a mediocre capital-intensive business barely growing at 3% while trading at a cheap 10 times multiple.
So what does this all mean for the person listening to this deep dive right now? I mean, it's definitely not about running out and blindly buying 100 shares of S&P Global or Uber just because Bill Ackman's delayed paperwork says he did.
Definitely not.
It's about adopting his lens. It's about looking at your own portfolio or even evaluating the industry you work in and asking, is this a capital-light compounder? Or is this a fragile business that requires infinite gourmet feed just to survive?
It's a profound shift in perspective, but to truly bring this home, we have to bridge the gap between billionaire finance and our everyday reality.
Let's do it.
Think about it like choosing a vehicle. You can buy a highly strung, temperamental sports car that looks cheap on the lot, but requires constant maintenance, premium fuel, and expensive imported parts just to keep running.
Yeah, the fixer-upper.
Right. Or you can pay a slight premium upfront for a wildly reliable Toyota that just quietly does its job for 300,000 miles with nothing more than routine oil changes. Ackman is finally choosing the Toyota.
He's tired of paying the mechanic.
He really is. And if we connect this to the bigger picture, it leaves us with a really provocative thought to end on. We started by exploring how Ackman has evolved from an aggressive activist, someone who fought exhausting, stressful battles to fix broken companies, into someone who simply buys great toll roads and lets them compound naturally.
Right.
If even the world's most aggressive, battle-hardened billionaire investors have finally realized that it is infinitely easier and more profitable to hold a naturally great system than to exhaust yourself trying to fix a broken one. Where in our own lives, our careers, our relationships, our daily habits, are we still exhausting ourselves trying to be activists instead of simply investing in natural compounders?
Wow. Yeah, maybe it's time we stop burning energy trying to flip the stressful fixer-upper and just start looking for the bridge.